It's time for Yahoo Finance's Market Minute. Stocks are turning negative. We started the session with the S&P and the Nasdaq in the green, but risk-off sentiment returning as investors await clarity on trade negotiations. United Health Group shares cratering, the healthcare giant missing expectations and slashing its guidance due to higher-than-expected costs in its Medicare Advantage business. United Health CEO saying the company is, quote, aggressively addressing those challenges. Meantime, Eli Lilly surging up 13% on positive results for its GLP-1 pill in its phase 3 clinical trial. Weight loss among the participants rivaling popular injectable drugs like Ozempic. And Taiwan Semiconductor shares higher after reporting strong earnings and maintaining its guidance for 2025 in the face of a trade war and chip export curbs. TSMC guiding for mid-20% sales growth and expecting AI-related revenue to double this year. That's your Yahoo Finance Market Minute. For more, scan the QR code to track the best and worst performing stocks.
Welcome to Wealth, everyone. I'm Brad Smith, and this is Yahoo Finance's guide to building your financial footprint. Our community of experts will give you the resources, tools, tips, and the tricks that you need to grow your money. Hey, on today's show, volatility in the bond market. While treasuries are usually considered a safe haven for investors, they've been a little wonky in the past few weeks. We'll bring you some tips for navigating the bond market in just a few moments. And speaking of safe haven assets, gold has been on a record run, currently in the ballpark of another all-time high. It now seems the big question, is it still the time to add it to your portfolio? We'll discuss that. Plus, all week on Wealth, we're diving into the class of 2025's financial playbook. Whether you're a new grad or a parent of one, we'll break down the basics that you need to build a strong financial foundation. Today's focus, building an optimized budget. You do not want to miss that. All right, all that said, we are 90 minutes into the trading action here, and let's kick things off with a look at the bond market here on the day. Treasury yields, you're seeing them a little mixed. The 5-year is down, just flat, barely to the downside, but you're seeing the 10-year and the 30-year hold on to some fractional moves higher on the day after Fed Chair Jerome Powell warned this week of the challenging impacts of tariffs uncertainty. Joining me now, we've got Noah Weiss, Allspring Global Investments Senior Portfolio Manager. And Noah, you say investors should be nimble and diversified when playing the bond market. Walk us through what that looks like within bonds.
Yeah, we've seen quite a few examples already this year and why that can help in investors. Obviously, large moves in markets broadly, but even more notable is the moves relative within these markets. And I'll give a couple of examples. In the first quarter and into March, we saw a lot of pressure on European governments to increase defense spending, increase fiscal support for their economies. We saw a big increase in yields in European government bonds and a rally in U.S. government bonds. We saw the opposite in corporate credit, where European credit markets ended up rallying and dramatically outperforming U.S. corporate markets. So that kind of dislocation, a big significant shift in these markets and that type of volatility creates opportunities. And in one where, in our case, we were able to shift capital out of European corporates, take advantage of that big rally that we saw, and then reallocate that capital into U.S. corporate bonds, which had underperformed and valuations had improved materially.
Yeah, and so Noah, when people hear the word diversification, investors hear diversification, especially within the bond market, that might sound to some like, yeah, just buy multiple and buy all the duration that you can get. But if there is a way to think about that more clearly within diversification, within bonds, what would that be?
Yeah, so we think it's really important that it's not just buying, let's say, more duration. It is getting different types of duration, and so that may mean getting some interest rate exposure outside of the U.S. We think that there are opportunities to do so. The inflation dynamics, for example, in the U.S. are increasingly diverging from what we're seeing in other developed markets because of tariffs. It's going to have an inflationary impact, potential upward pressure on U.S. interest rates. More of a deflationary impact for those more export-oriented economies. Think about a Germany, for example, where that's going to lead to probably lower growth lower inflation and possibly lower interest rates. And so I think it's more of kind of where do you get your interest rate exposure? Where do you get that duration? But then also along the curve. One thing we would point to is even within the US and US interest rate exposure, you're usually getting a higher compensation for taking longer term interest rate risk. Think 10-year bonds, think 30-year bonds. The difference, the incremental income yield that investors get for taking that longer term risk is usually about 1 percentage point more in 30-year bonds than it is in 5-year bonds. We're getting a little bit less than that today. And we think that's going to increase. We think all this uncertainty, all this volatility, that should lead to investors saying they want more of a premium for taking that risk rather than less. And that means higher interest rates in the longer end of the curve, probably stable to maybe even lower interest rates at the front end of the curve. So it's not so much about taking more duration or less duration, it's kind of where you're taking that duration exposure.
And so with this in mind, you also mentioned that interest rates are caught between higher inflation and lower growth as of right now. And we've heard from a lot of economists that they're expecting kind of a wobbly first half of the year with a growth scare potentially. What does that translate through to the bond market from your own kind of modeling and assessment?
Yeah, so for us, we do see something similar. We think that all of this uncertainty kind of unleashed with tariffs, but not just tariffs. There's immigration policy changes. There's unknowns around how fiscal policy dynamics are gonna play out. All of these factors we think are likely going to have a bigger impact on growth here in the short term rather than inflation. Yes, it's going to put upward pressure on prices, but we don't think that the consumer is in as good of shape as they were a couple of years ago. A couple of years ago, plenty of balance sheet liquidity, a lot of cash coming from post-COVID stimulus. A lot of that has been spent down over the last couple of years. So I think when we see higher prices again, that's actually going to lead to lower economic activity. That means more of a growth impact than necessarily an inflation impact. And again, we think that supports the front end of the curve. The front end of the curve possibly moving lower from here. The longer end of the curve, dynamics around inflation, potential deficits, supply from the Treasury likely leads to higher premiums in the long end of the curve and therefore a steeper interest rate structure.
Noah, thanks so much for taking the time to break this down for us. Really appreciate it.
Thank you.
It's now time for some of today's trending tickers. We're watching chip stocks, NVIDIA and AMD. Plus, we're also watching Hertz. Joining me now, we've got our very own Alexandra Canal. First up, we got to talk about NVIDIA, Ali. NVIDIA and AMD, they are falling. They were in the green earlier during today's session on the back of a solid report from TSMC. Now they're continuing some of that selling that we saw during a brutal trading session on Wednesday. Investors eyeing that $100 level for NVIDIA, and it seems like we are just within that parking lot right now here, Ali, as we're taking a look at shares down by about 3.25% for NVDA right now.
I know, another 3% decline. $100, that's a psychological level for a lot of investors. They're thinking, hey, maybe I should be getting into this stock if it's going to continue this downtick. Now, for a company like NVIDIA, there's been a lot of headwinds, right? We constantly have been talking about this uncertainty with trade, with tariffs. NVIDIA has promised to, do domestic manufacturing. They've CEO Jensen Huang has had dinners with President Trump, visited the White House. So there was a lot of thinking that NVIDIA would be exempt from some of these tariffs. Clearly, that did not happen, which is why we're seeing shares sell off today, continuing that sell-off that we saw on Wednesday. If we take a look at that 52-week range, we're right in the middle there. But year to date, we are down about 25%, which is just astonishing, considering this was a name that really led stocks higher over the past 2 years, and now we're seeing them, seeing shares at least do the exact opposite here. So I think the next catalyst, if we don't hear anything else on the trade front in terms of greater clarity, it's going to be that earnings report. Strategists have said NVIDIA could go the way of United Airlines, maybe giving two different types of guidance, one a solid guidance, and then maybe one adjusting for a lot of the uncertainties, or at least what we know at this this point, but certainly a big company that we constantly talk about. It's just hard to really know what the future holds when there's just so many unknowns out there right now.
Yeah, well, one thing that I'm looking to take my cues from right now, at least, is the options market. Based on options contracts, it seems like by the time we see this next earnings print, May 28th is that timing for NVIDIA, we could see a move to the upside or downside by about 15.3%, as is priced in by options contracts right now. So that is something to keep an eye on here. Also, we're keeping an eye on shares of Hertz. Hertz shares extending gains, bringing the two-day jump in the stock to around 100%. This is on the back of the news that billionaire Bill Ackman's hedge fund is now one of the top shareholders in the rental car company. Pershing Square Capital disclosing it's acquired nearly 13 million shares of Hertz stock. Shares of Hertz higher on today by about 24%. This adds on to the move that we had seen yesterday as well.
Crazy. 2 days of double-digit gains. Year to date, the stock is up 100%. Now, Hertz, it was the original meme stock back in the time of the pandemic. They filed for bankruptcy, then they doubled down on their EV fleet. They purchased around 100,000 Teslas that ultimately did not pay off. As if you're a renter for a car, you probably don't want to get an EV if you're planning to travel far because the infrastructure is just not there yet. There were a lot of concerns over charging stations. So that ended up being a bust. The fact that Pershing Square Capital is coming in, they often take activist positions. So investors optimistic about that. Now, this is a company where we talk about a lot of the companies that maybe aren't doing so well from the tariffs. This is one that could actually benefit because if car prices are going to go higher, perhaps buyers will explore the rental market a little more closely. So that's something that we could continue to watch to see if there's any boon potentially there for a company like Hertz. So just a crazy stock. But again, remember, meme-like qualities, fundamentals a little shaky. We'll see, though, if Bill Ackman can get the job done.
It'll be interesting to see as well if Hertz starts marketing because some of the rental car companies out there, they also offload some of the vehicles that they have when they're looking to retire them from their fleet. So that's also another used car sale input. And if they start marketing them as tariff-free, go in the way of some of the other auto manufacturers, we'll 100%. See what that means for them. Allie, thanks so much.
Thank you.
You can scan the QR code below to track the best and worst performing stocks of the session with Yahoo Finance's Trending Tickers page. Coming up, investment advice for every age. We have everything that you need to know next on Wealth Plus. Google, Alphabet, whatever you're calling them, call them partially losing their advertising antitrust case here. A judge ruling that the tech giant did illegally monopolize some ad tech markets. We'll break it down with our tech editor later on this hour. Stay tuned. The Philadelphia Fed taps Anna Paulson to take over as the bank's president and CEO. She is replacing Patrick Harker, who is retiring in June after 10 years leading the bank. Paulson is coming from the Chicago Fed, where she spent most of her career. Paulson served as executive vice president and director of research at the bank, focused on financial stability and monetary policy. Paulson saying in a press release, quote, "I look forward to leading the Philadelphia Fed team, who are deeply committed to fostering the stability, integrity, and efficiency of the nation's monetary, financial, and payment systems." This move comes as President Trump is pressuring the central bank to cut rates. Fed Chair Jay Powell has maintained the FOMC's preference to hold until they are sure the dual mandate is on track. Trump posting on Truth Social this morning that Powell is, quote, "always too late and wrong," end quote, and that Powell's termination cannot come fast enough. Anna Paulson will take office July 1st. Investors have been feeling uncertain about their portfolio allocations as most 401ks have been pummeled by market volatility the last few weeks. So we want to take a step back and break down how you should be allocating your portfolio depending on your age. For that, we have Kevin Justice, who is the Senior Vice President and Head of Nationwide's Investment Management Group. Good to have you here with us. So let's start with those just starting out in their career. How should they be allocating their money?
Yeah, thank you, Brad. Great question. So it's important to remind young, early investors about the importance of beginning an investment program. For many young workers, that can be achieved through a defined contribution plan sponsored by their employer. And so it's really important to think about budgeting, investing for yourself, investing for the long term is a key component of those early decisions you can make to set yourself up for success in the long term. Sometimes the volatility discourages people from beginning those investment programs. And it's really important for all of us to remind young workers how important it is to begin saving early and the power of compounding to generate long-term wealth for their long-term retirement planning.
So should young investors be putting even more cash in right now to, for what everybody has been raging about on social media, buying all the dips?
Great question. So I often remark that stocks are one of the very few things we don't like to buy when they go on sale. If I were to go out and buy a new shirt or a new hat, I'd love if it was 15 or 20% off. But with stocks, we like them to go up forever. And there's a lot of psychology behind that. But important, without necessarily calling a top or bottom in any market environment, when stocks dip in value, when the market goes down, it creates a buying opportunity. So to the extent you have discretionary cash available, certainly any dip, a discount, a sale on the price of stocks, if you will, can create a great opportunity to invest. Important, though, to remind everyone to stick to a long-term financial plan. Whether you're an early investor starting out or you've been in the markets for decades, it's really important to write down a long-term financial plan and stick to it. But market corrections and dips create good buying opportunities to get capital to work for your long-term wealth building.
Now, say you're mid-career, how should you be allocating at that point?
Yeah, so mid-career investors are often complicated portfolios by the fact they've been saving for some years, investing, potentially using 401ks, 403bs, IRAs, may have children in their family structure, have 529 accounts for them. So important to get the right accounts and the right structures for your investing and saving needs. That's an important component. The second is thinking about the asset allocation of the portfolio. For a lot of mid-career investors, the investment horizon is still decades away. Not only is retirement potentially 10, 20 plus years away, but we as Americans expect to live longer on our retirement assets post-retirement. So we think about retirement at 65. If you're mid-career in your 30s and 40s, early 50s, you want those assets to live not only to 65, but for potentially 20 or 30 plus years into retirement, very long horizon. So within our own target date funds, we have an allocation that in the early career stage is 90% equity, and then decelerates from about 10% increments throughout that mid-career stage, from 90% all the way down to 40% into retirement for the equity allocation. But again, we recommend that being a long-term strategic asset allocation and not encouraging people to time the markets per se, but important to have a healthy equity allocation through our working careers and saving and investing lives.
It sounds like this is the part of your life where things start to get a little bit more complicated, where you've got more assets, whether that be in your portfolio, your real estate, your family life as well coming together. Is this the part of your career when you should think about getting a financial advisor?
Wonderful question. So the answer is yes. For many people, there are great resources available through your defined contribution plan, employer-sponsored savings plan. You can use those to get started, financial literacy and education. But as your life and your portfolio and your needs and your expenses in your life become different and varied and more complicated, it can be really valuable to partner with a financial advisor who can tailor a portfolio and a financial plan to your unique custom needs based on your income level, your tax structure, your time horizon, and your risk tolerance. And then importantly, help you through periods of volatility like this to understand where opportunities may exist and help you stay true to that long-term plan.
Just lastly, while we have you here, pre-retirement, should you begin allocating away from stocks?
So as you're approaching retirement, we would expect there to be a declining allocation of stocks in your portfolio, a shift toward more fixed income to moderate the volatility. But important, your horizon, even as you're approaching retirement, is likely still multiple decades into retirement, given the longevity of lifespans we have now. And so it's important to have that equity allocation as a buffer. That equity allocation helps achieve real inflation-adjusted growth in your portfolio over the long term. So as we approach retirement, we expect declining equity allocations, but there's still to be a healthy allocation to stocks across portfolios to provide that long-term, multi-decade source of growth.
Kevin, thanks so much for taking the time here with us today.
Thank you, Brad.
Well, tax day is officially over, but that doesn't mean you should toss all of your financial statements into a drawer and ignore them for a calendar year, especially if you're retired. Here with several things seniors can do right now to make your 2025 taxes just a little bit easier, we've got Yahoo Finance senior columnist Carrie Hannon. Hey, Carrie.
Hey, good morning, Brad. Great to be here. There are some things that people can think of. I've got a list of 5. I'll try to go through them quickly. The first one is pay attention to your required minimum distributions, your RMDs. And now, starting at age 73, is when people need to start paying attention to this. Many people are already doing this. What's important this year to remember is that this number is calculated by the size of your portfolio, your retirement assets, tax deferred, December 31st, divided by your life expectancy that the IRS has come up with in their chart. So the news is that the markets were crazy high and giddy at the end of the year, December 31st. So you're going to have, even though markets have dropped down or are volatile right now, what you're paying on is that number, the amount you're going to take out is going to be calculated. So you're going to have a higher amount this year, potentially. So really plan for that. You can also, something that's important to note is that at age 73, you need to start taking, you have until April of the following year. So if you turn 73 this year, you have until April to take that first distribution, but you will also need to take another one in December. That means that you'll have two RMDs next year. So the advisors I spoke to said, you might think about taking that first RMD this year instead of delaying it until April, just to even out that tax burden. And one reason, we were saying that the RMDs are going to be high, but another expert, Ed Slott, I spoke to, said, hey, maybe that's a good idea because tax rates are still historically low this year, and potentially they could bump up next year if the tax law that was temporarily put in place that is due to sunset this year is not re-upped. And so you might take advantage of those lower tax rates and go ahead and do that. The other thing folks can do is a charitable it's called a qualified charitable distribution. And if you're a charitably inclined person, and you would give to charity anyway, this is one thing you can do with your required minimum distribution, your RMD. You can direct it to go directly into a charitable organization. And that is one way to satisfy your RMD and do good at the same time. There are some other tax breaks that people might consider around the edges. For example, if you're considering aging in place and you might want to revamp your home a little bit, there are tax breaks for energy efficient home improvements that you might look into, or look at other things like investing in tax exempt bonds that are free from federal tax and in many cases local and state tax as well. So I know that's kind of a quick rundown, but there are things. The important thing, Brad, is for people to start paying attention to what their likely tax bill is going to be in 2026.
Carrie, thanks so much for breaking these down for us. Really appreciate it.
Thanks.
Coming up, investing in gold is now the time to add it to your portfolio. We'll discuss next on Wealth. Gold prices pulling back a bit this morning, a reversal from the all-time highs that we've seen as investors pile into safe haven assets amid tariff policy uncertainty. Some experts linking the declines to investors taking profits from gold's gains. How should you navigate gold as an investment for your portfolio? Here with more, we've got Michael Gayed, who is the publisher of the Lead Lag Report. Michael, always a pleasure to grab some time with you. Even as we take a look at the price of gold here this morning, let's just kind of hold space for a second at the fact that we're still holding above this 3,300 level, and ultimately there were larger questions around more largely what's the kind of all-time high new marker should be that we're thinking about gold. What is kind of your best analysis as to what's pushing this and how much higher we could continue to run?
Or maybe if the high is already in, I think is another way to rephrase that question. Sure. Listen, I turned quite bullish on gold October 2023, and the last 3-4 weeks I've been getting more and more negative on gold's price, which looks like it could be entering some kind of manic fervor phase as I see more and more people convinced that the recent past is going to continue into the future. Let's take a step back. Gold tends to do well when there's demand for non-correlation in a portfolio. It's one of the few assets that tends to not really be correlated to anything. It marches to its own beat. It's not correlated to inflation. It's not correlated to deflation, not correlated to the dollar, not correlated to stocks, not correlated to bonds. So when especially institutional money is worried about a cycle turn in risk on assets, that institutional money tends to find its way into gold as a way of lowering intra-portfolio correlation. Now, nobody turned bullish on the retail side up until recently, which is, you can argue to an extent, typical because retail, no disrespect to retail, but retail tends to get in when it's often too late. And I think we're getting close to that point in the way gold prices have acted now. I have made the argument for the last several weeks that if we are in the early stages of what could be multiple pulses of margin calls, given the volatility that we're seeing in stocks, it is only a matter of time until gold becomes the source of liquidity to cover those margin calls. There's a very specific reason for that. In behavioral finance, there's something called the disposition effect, which means that people tend to sell their winners before they sell their losers. Well, guess what, folks? Gold is one of the few winners left now.
And so with that in mind, and if we did see gold used as a liquidity mechanism for people to cover those margin calls, what does that spell out for the rest of the markets?
Well, it should spell out better opportunities to buy low because at that point stocks would be lower and credit spreads would widen, and you'd probably see treasuries stand alone as the risk-off asset, the Phoenix rising, which is my whole gimmick and why I always wear this chain here. So the broader point here is that I don't believe gold necessarily is going to enter a bear market. But if you're going to be tactical in your timing, you might want to wait because it seems very plausible that if you just look at history, gold probably will sell off with everything else, but with a lag, right? And that's sort of the argument of the covering of the margin calls. I do think there is a longer term argument for gold because independent of my own personal views on treasuries acting as the ultimate safe haven risk off asset in those pulses of fear for stocks, the whole idea of crashing stocks to save bonds, I do think that gold will still benefit anyway because we're probably in a bear market. And one that could last for a while. And I go back to retail is so used to buying the dip. The only way you punish that mentality is to make them keep buying the dip, and the dip gets dippier, okay? It keeps going lower on equities, right? In other words, there has to be a time aspect to retrain this mentality.
Michael, I wonder, as you're looking across the equities market right now, and you're seeing, still somewhere around 80% of the S&P 500 below their 200-day moving average right now, what are the technical indicators that are firing off signs to you of how to position your portfolio? Yeah,
I mean, it's far worse, as you know, for small caps. Small caps which are now halfway through a lost decade. Tell me more about this bull market we've been in when the majority of companies are back to 2020 levels. By the way, nominal, not after inflation. Look, I typically when you're below 200-day moving average, you tend to have volatility clustering, meaning you tend to have big declines and then big advances, like we've seen the last 2-3 weeks. To why I keep making this point that bear markets make fools of bulls and bears, because you end up having whipsaws galore when you're in these kinds of environments, ultimately with a path that's going to look like a downtrend, but becomes very nasty to sort of try to trade around. I think that's a dynamic that's going to persist for a while. And by the way, I think that's a dynamic that's going to persist for a while, not because I'm some perma-bear, but because, let's face it, the valuations are still very stretched. We can keep on blaming Trump from here until tomorrow. We can keep saying it's about tariffs. The reality is any spark, when the tinder is that dry, we'll light it up. Doesn't matter if it's Trump, doesn't matter if the reverse carry trade with Japan. When valuations are this extended and disconnects are this prevalent, it doesn't take much to have this all unwind. Now, all of this should be perceived as a good thing. Okay, and I say that because if you're going to be a real long-term investor, you want to buy low. I don't understand this obsession with things have to keep going higher and higher. Everybody should be rooting for a correction, rooting for a crash in stocks, in gold. Because if you got time on your side, then you might as well get it out of the way now.
I guess the other side of that too, of course, is what we're seeing within the economy that would actually lead investors to flee from some of those positions, at least in the near term. That is a conversation we'll have to continue to have. Michael, I got to leave things here on the day. Good to get some time with you. Would love to have you back.
Appreciate it.
Thanks. Coming up, Google partially losing its advertising antitrust case, a judge ruling the tech giant did illegally monopolize some ad tech markets. We'll break it down with our tech editor. That's after the break. Stay tuned. A federal judge ruling that Google illegally monopolized 2 ad technology markets in the latest antitrust blow for the tech giant. The ruling could lead to a breakup of Google's lucrative advertising business. And here with the details is Yahoo Finance's Dan Halley. Dan, we're taking a look at shares moving lower by about 1.5%. What are some of the details around this?
Yeah, the federal judge had found that Google had monopolized the markets, including publisher ad server market and ad exchange market. They were not found to have monopolized the third market that was up for debate here. This case came from the DOJ and a collection of 17 states. It went to trial in September, and this is the second major antitrust loss for Google in less than a year. Previously, they had lost their antitrust case as far as search goes. They're still trying to figure out what the results of that loss will be and what kind of punishments Google will have to face. Now there's going to have to be a phase where in this trial they come up with what kind of results will be, what kind of remedies there'll be for Google in the ad space. And so these are 2 major blows to the company. The advertising business, obviously massive for Google. That's how they make the vast majority of their money, the search business being among its most profitable and where it helps to drive a lot of that search. And so this is going to be a big problem for Google, obviously, going forward. They're going to fight this. They're going to appeal this and see how far they can go. These kinds of kind of back and forth between the government and the Google and the judges in these kinds of cases can go on for years. So we're still far from any kind of firm ending, but Google has absolutely got its back against the wall in this case. And they've been dealing with this not just in the US, but around the world as far as its advertising and search business goes. So this is really just kind of the latest sting that they have to deal with.
All right, Dan, thanks so much. We'll continue to track shares in reaction of this. We know this is a major part of their business that investors have built their thesis around with their advertising business. Appreciate the breakdown. D.R. Horton sounded the alarm on housing demand in its recent earnings report. The home builder cut its full-year outlook, citing a slower than expected start to the home buying season, as would-be buyers remain cautious. Here to discuss the spring home buying season, we've got Adam Pretorius, who is a real estate agent with Lepich Kroger Realtors working in Iowa City. Good to have you here with us, Adam. Would you agree with D.R. Horton's characterization that the spring home buying season has been off to a slow start?
Well, here in the Midwest in Iowa, we're seeing actually an increase in sales. I mean, we just came off last year, one of the worst years we had in many decades, where we were at an all-time low, sales had declined. But this year we've seen a 10% increase. But I think buyers are becoming more picky. They're choosing between their options much more, and new construction has had such a large increase in costs that many are looking more towards resales.
And so let's talk about inventory. Census data showed new residential construction in March. It fell by the most in a year. What are you seeing in terms of supply and demand in today's market?
So it's still a complete mismatch, right? That is the biggest problem in real estate is we just don't have enough supply to meet the demand. And that goes for both rentals and for purchases. Those are your 2 options when it comes to housing. And that is creating much of the issue with pricing. I mean, we've seen prices even last year with the sales going down. We still saw prices go up 7%, which shouldn't have occurred. You'd expect the opposite. But this year we've seen prices still increase another 10% off that. So prices are probably the biggest issue, which is just a product of that mismatch of the supply and demand.
Now, you tend to work on the more luxury end side of the scale here, higher cost luxury homes. Have you found that the traffic in your area, what have you been able to make of that? Is it folks upgrading their house or people relocating to Iowa City from other places in the U.S.?
Yeah, I mean, during the pandemic era, we saw a surge in people doing much more remodel projects. And now we've kind of seen that pull back a little bit. The new construction has softened in the luxury market. We haven't seen quite as much new construction sales as we did during the pandemic. But we're seeing a little bit of a resurgence in that luxury market locally. But the days on market for new builds is much higher than it has been, say, during the pandemic in the last 4 years. And the capital that people are able to get, for builders to get rather, to do these projects has tightened up as rates have gone up. And not only is it harder to get capital? But when you do get capital, we're now seeing, the cost of capital anywhere from like 9 to 10% on these loans, which is double what we saw during the pandemic era. So builders are having to pass those costs on, and most of construction is cost plus pricing. So we just see those prices increase, and it makes it much more challenging, I think, when a buyer's faced with the option to buy a new or a resale, to go for new when those costs keep going up.
You shared 3 strategies for sellers in this environment: pricing, timing, and positioning. Could you break those down for us?
Yeah, I mean, every market is their own local sport. So every market's going to have different market cycles. And you should really work on timing. That is such a big product of pricing. We always focus on pricing, but we don't think about timing as much. So locally, for example, I have a spring and a fall market. Our slowest time of the year is August, July, and June in that order. So if you're a seller, it doesn't make sense to go on during a slow market. You really want to make sure that you time things ahead of time. And then positioning, because positioning is what we make value propositions on as buyers. It's what your house is versus another house is worth. And that's often what we see on new construction too, because resales are a product of the cost to build new. And so resales are a discount of new construction. And so more people will flock towards resales if the discount is enough versus the cost to build new.
Yeah. Following on that positioning comment, you mentioned the power of social media in today's market. What should sellers look for in their agents' Instagram or TikTok as they're looking to try and make sure that they're kind of meeting people, meeting buyers, where they're spending the most screen time?
Yeah, this is totally crazy to me. But we went from using the book pre-century, where every brokerage had their own book before the digital age, and then we went to the internet, and the internet sold real estate, and now social media is selling real estate. So it's no longer just going to look for your agents present online, their website. Go check out their handle, their profiles, their social media strategies. What is that presence? There's a reason why so many companies are putting so much money into social media. And that's because it sells products. It also sells real estate. And so make sure that the agent that you hire has a good social presence, that they're actually able to broadcast you to channels, because social media reaches such a bigger market, not just your local, but maybe it's relocation buyers from outside of town or across the US or internationally. Yeah,
also might help some agents get a real-time pulse of the market and their pricing strategy too. I was looking at one real estate agent in my hometown of Philadelphia, and they had a post up there that had a poll that said, is this too much or not expensive enough? And it was like 97% of people that were like, this is too much. Don't do this to us. So great points on the social media reach there. Adam, thanks so much. Appreciate it.
Thanks for having me.
Coming up, we have your 2025 graduate playbook. Today, we give you everything that you need to know about building your budget and opening your first credit card. A new study from student loan company College Ave found less than half of college students kept a personal budget while in undergrad. Whether you're in the majority who have never kept a budget or a parent looking to prepare your child for the real world, don't worry. As part of our theme week, the class of 2025's financial playbook, we're getting back to the basics of budgeting. Here to help, we've got budgeting expert Andrea Warrock. Great to have you here with us. Okay, so first, let's just start basic perhaps. What advice would you give someone who's never had a budget before?
Well, thank you for having me. Well, a budget is such an important tool to help you reach your financial goals. And the most important thing that I want any viewer thinking right now is to reframe the way you think about a budget. A lot of people look at budgets as being restrictive, not allowing you to live your best life, not allowing you to enjoy certain expenses or purchases. But the reality is a budget can give you flexibility and freedom. It allows you to really pay attention to where your dollars go, so nothing is being wasted. And that just allows you to be more allows you to really create the lifestyle that you want. And so to begin with your budget, you really need to figure out, are you living within your means? Are you spending more? So write down your take-home pay, list out all your expenses, your necessary expenses, plus maybe an average spend on those expenses where they are, fluctuating from month to month. And then this gives you a snapshot of how you're spending. And now you can begin creating a plan to cut back in the areas where you're overspending. Remember, you cannot change what you can't see. So writing it all out on a piece of paper or an Excel chart is a great place to start. And of course, there are budgeting apps as well that can help you out.
Right. And so if you're looking to build a budget that will last, what are some ways that people can stick to their personal finance plan?
Right. Okay. So first of all, maybe determine what kind of budgeting method works best for you. There's a rule called the 50-30-20 rule, and this assigns 50% of your expenses towards those necessary bills like rent, mortgage, healthcare, gas, food for groceries, 30% to the lifestyle expenses like entertainment, vacation, gym memberships, and then 20% to savings. I like to save before I pay any of my bills, so I know that I'm reaching that goal. Now, the most important thing to sticking to your budget is making sure that you are actually paying attention to where your money is going. And so I mentioned budgeting apps are a great tool to ensure you're sticking to your plan. I like Rocket Money. There's also You Need a Budget or Pocket Guard. All of these link all your financial accounts in one place. So if you have multiple credit cards, a checking account, savings account, you can see it all in one place. And this way you really know where your money is going, that you're sticking to those spending categories that you set for yourself. And also, this doesn't mean you can't spend on certain expenses, but just be really savvy on how you are spending. Make sure that you're comparing prices, make sure that you're applying coupon codes when possible, and then also shop at stores that offer affordable options. I like stores like Dollar General. They post thousands of items in their Value Valley that cost just $1 or less. And you can access this through their app. And this is going to be for groceries, personal care items, healthcare items. This could really help you stretch your dollars, stick to your budget. And this is a good tip for anybody out there who feels like, well, they're being deprived, like, they don't want to cut out all those Starbucks purchases or maybe, going to the movies and those types of things. Tap into the free rewards that you get from credit cards, retailers, or even apps. This is a great way to indulge in a splurge without derailing your budget.
Yeah.
So for instance, make sure you're using a robust cashback credit card. I like the Bread Rewards American Express credit card because it offers 3% back on groceries, gas, dining out, and your utilities. So you're paying for those things anyway, earn that cash back. And then also use an app like Fetch. This is a rewards app that will give you points for all your purchases when you snap a photo of your receipt. Then you could redeem those for gift cards to Starbucks, Sephora, Amazon, and then indulge in a splurge, again, without derailing your financial goals.
Just briefly, I got about 40 seconds here. What advice do you have for parents of soon-to-be college graduates who want to talk to their kids about setting up a budget?
Yes. So I think it's really important to talk with your soon-to-be graduate about what their goals are. Are they planning to try to find an apartment to live on their own? Are you going to help them out by allowing them to live at your own home? Even if they are living with you while they look for a job, this could be a good opportunity for them to get a little bit of experience of what it's like in the real life. Maybe you could charge them a small rent. Maybe they can contribute to the household bills. Sit down with them and show them what different things cost so that they can start preparing for that reality in the future that's yet to come. Also, this is a good time to also start thinking about student loans. When are those repayments going to be in effect? And making that part of the plan as well.
Andrea, thanks so much for taking the time here with us. Really appreciate it.
Thank you for having me.
Sticking with our new grads, whether you're new to credit cards or have a few years of spending under your belt, listen up. Senior writer Kendall Little joins me now with more tips on how to be smart with your credit cards. Kendall, good to see you. Let's start simple. There are some college grads who've never had a credit card. Where should they start if they want to get one?
Yeah, so if you've never had a credit card at all before, a secured credit card is a great place to start. These are usually going to be a little bit easier to qualify for because they require a security deposit to open. Over time, as you sort of build your credit, you can qualify to upgrade to an unsecured card with that issuer and get that deposit back. Some credit card issuers are also going to have credit building cards that aren't secured from the start. You're not going to find those great rewards and benefits, but you can use these cards to increase your credit score and then, of course, get a more rewarding card in the future.
What about for folks who have a few years of spending under their belt and they're trying to kind of weigh their options when it comes to cards?
Yeah, so whether you had a student credit card in school or maybe you were an authorized user on a parent's card account, you might have a few more options. You can, of course, continue to use that student credit card. Most issuers are going to let you keep spending on that card even after graduation. Or you might want to take that good credit that you've built and upgrade. I like to recommend cashback credit cards for recent grads. You can earn savings on those expenses that you're going to be taking on, whether it's groceries, gas, even things like streaming services and utility payments.
So break down just the benefits of having and using a credit card for us.
Rewards are definitely a big one, whether you're earning cash back rewards, travel, points and miles. But I would say the biggest benefit is really that opportunity to build credit. Your credit card issuer is going to report your card activity to the credit bureaus every month, and that's going to show up on your credit report and affect your credit score. So as you make your payments on time, you spend within your means, and you don't spend too close to those credit limits, you're going to really help yourself in the future when you go to apply for loans and want to get really great interest rates on those loans.
Absolutely. Kendall, thanks so much for breaking these down.
Of course.
That's it for Wealth, everyone. I'm Brad Smith. Thank you for watching. You can stay tuned for Market Domination coming up at 3 p.m. Eastern Time.